Okay, that long 5-minute break is over. And we will continue on with our meeting. Thank you. Our next item is audit report. We have our auditor with us tonight, Mr. Badawi, and we will turn the time over to him.
Is that a remote or? Okay. All right. Good evening, Madam Mayor, members of the council, and members of the audience. It's good to be here again, presenting to you the results of the 2018 audit. I am going to start on slide number 2 and just let you know what I'm going to be covering today. I'll let you know who the engagement team was, the deliverables and the scope of our audit, areas we emphasized on, the type of audit opinion we issued, and summarize for you some of the numbers in your financial statements, provide you some of the required communications as your independent auditor, and see if you have any questions for me. Of course, you can interrupt me anytime if you have questions. On slide number 4, you will see the composition of our engagement team. So I was the engagement partner. We always have a quality control reviewer. So that individual is in the background. They are usually not in direct communication with the city. And their role is to review my work and making sure that we adhere to professional standards. I had one of our managers, Mitesh Desai, was on the audit. We had a senior, Ed Basowski, and we had a couple of staff that rotated in and out of the audit. We also have an IT specialist that would normally assist us in, if we need him, in evaluating the city's computer system and the control embedded in those systems. If we go to slide number 5, those are the deliverables and the scope of our audit. So we were mainly engaged to provide an opinion on what we call the city's basic financial statements. So that's the report that includes all city funds, all city assets, liabilities. In addition to that, because the city is subject to what we call government auditing standards, so we also have to issue an opinion on our consideration of the city's internal control over financial reporting and on any compliance and other matters that could have a material effect on the financial statements. So we are ready to issue that report. We perform what we call an agreed upon procedures on your appropriation limit. That's really looking at your tax revenue base and adjusting it for population increase and inflation, and that determine your cap for how much you can budget in the following year. And then finally, the communications with those charged with governance. That's what I'm doing today, and normally we would issue a letter summarizing those communications once we are completed. On the next slide, areas of primary audit risk. So we have 3 main areas that we consider to be of a higher risk. The first area is the risk of management overriding control. This is not unique to the city of Lindsay. Management are normally the one who design the controls. They are the one responsible for monitoring those controls, and they can choose to override them at any time. So we have to design our audit procedures to try to bring that risk to an acceptable level. So we try to, yes ma'am.
Why would a manager override? What reasons would there be for a manager to override the system?
It can be sometimes for valid reasons, and sometimes obviously for reasons that you don't want to have, like management attempting to embezzle or commit financial fraud or anything of that nature. They will have to override controls to be able to do that. But sometimes management may override controls just because of trying to simplify something or to process a transaction quickly because of whatever reason. Anytime there is an override of control, we want to make sure we understand why did it happen, what were the circumstances, was it appropriate under the circumstances. We're not aware that there were overrides of control during the audit process. Of course, there may be minor things. If you had an invoice that was an emergency and needed to be paid, maybe there was no purchase order at the time because you had to fix something right away, so that would be an exception or an override to control that would be acceptable to us. But then, of course, there are some that are not acceptable, and we're not aware that those has occurred. But we have to design our audit procedures to be able to detect those. So we try to incorporate an element of unpredictability. We don't do the same test year over year. We test journal entries prepared by management because journal entries is the most typical way of how management can manipulate numbers and amounts. So we test them, make sure that we understand the reason why they were prepared, that they are properly supported by documentation, and that the controls were followed. So somebody reviewed them, somebody approved them before they were posted into the accounting system. Excuse me. Another area of risk is revenue recognition. Again, by nature, people like to have more revenues and less expenses. Just the motivation is always there to overstate revenues. So by default, revenues are an area of a higher risk unless we can prove otherwise. And honestly, we don't try to prove otherwise. We just take it as is and design our audit procedures accordingly. And then the final area was the pension and OPEB, the retiree medical benefits. And those are significant for us just because of the dollar amount involved. There is also a level of complexity in the accounting, how to capture those activities that occur in these plans. So we communicate directly with the pension plan, with the auditors of CalPERS. We obtain reports from them on how much assets the city have invested with the plan. We review the actuarial assumptions. And the same with the retiree medical benefits. The retiree medical benefits, the city is the one that hired the actuary. So we test the census data that was provided to the actuary to prepare the study. We review the assumptions and make sure that they are reasonable under the circumstances. And then finally, we review management entries to make sure that those were recorded correctly in the books. If we go to slide number 7 or number 8. So this is regarding our auditor's report. So the good news is that we issued what we call an unmodified opinion. And what that means is that we agreed with the city's numbers. And I'm going to go into more detail as to what an unmodified opinion means. However, we do have 2 paragraphs in our opinion that are very, very important. One of them is, none of them are new. They existed from last year. The first one is the going concern, which obviously has to do with the city's financial condition, and I'm going to talk about that in more detail, and the other one relating to non-compliance. And again, it's not new, and I will be discussing that as part of the findings. But when we put something in the audit opinion like this, we're basically highlighting the fact that this is extremely important and extremely material. That is not just a disclosure somewhere, it's on our audit opinion, bringing attention to the reader that you need to read about those matters. The audit opinion does state that the audit was conducted in accordance with generally accepted auditing standards and government auditing standards. And what an unmodified opinion means, it means that the financial statements are fairly stated in all material respects. So whether you like the numbers or not, they are accurate numbers, and that's what we're really reporting on. Also, it means that the significant accounting policies have been consistently applied, that estimates are reasonable, and that all disclosures are properly reflected in the financial statements. If we move on to slide number 10, this is just a summary of your financial statements, what's in your financial statements. This is a 30,000-foot view of the city's financial assets and liabilities. So this is not digging into the general fund or the individual funds, but just taking everything combined. So on this slide is the composition of the city's assets over the last 3 years. So the one thing I would point out is look at your cash and investments, how much it was in 2017 and how much it is in 2018. That's obviously a very positive sign for us to see. Most of that was the general fund had good operating results, mainly because of new tax measures, and also there were some repayments of some loans receivables. If you see that loans receivable went down from 14.5 to 13.9 million. So that made up the almost $2 million increase in cash, 1.9 million or so. So that's definitely a positive sign that we saw. Obviously not out yet, but it's definitely a positive sign. If we go to slide number 11, that's the compositions of the city's liabilities. you will see that there were no significant changes. Pension and OPEB obligations, again, there were really no significant changes over the year. Just regular repayment of long-term debt. The only significant change you see in that unearned revenue, that's just an accounting correction. It's basically relating to those housing loans. They used to be put in an account called unearned revenues, and now they're just part of fund balance. But nothing has really changed in terms of the city's position relating to those.
Now what, okay,
Now they're just part of fund balance. It's just an accounting, moving it from one line item to another. We don't believe that it was corrected, it was recorded properly in the past. So we just corrected it. But nothing has changed in terms of the balance of these loans or anything like that. It's just an accounting classification issue. More than happy to clarify more after if you
yeah,
like.
because at one time we did have a problem with our housing accounts.
Sure, but I'm aware of the problem, and it is part of the compliance issues that we're going to be discussing. But I'm just saying that this was really just moving where do we record that amount from one line item to another on the financial statements. There was no more than that.
So now you're recording it where?
We're now recording it as part of fund balance, as restricted fund balance.
It is a restricted.
It is restricted, definitely. All right, on slide number 12, that's the composition of the city's equity. So this is just taking your assets minus your liabilities. So no different than looking at your home and taking the value of your home minus your mortgage and determining what is your equity there. So you can see that the equity is divided into three categories, and that's very important. The first category, the net investment in capital assets, that's not in a spendable form and most likely would never be in a spendable form. This is the amount of money that the city invested on streets and roads and infrastructure. So unless you're able to sell those, you're never going to be able to convert that into cash. Then you have the restricted amounts, and those amounts have legal restrictions. So the city council cannot decide how to spend them. Oftentimes, these amounts represent grant revenues that were not spent, the loans receivables in the housing fund, any kind of like gas tax money, those types of things that are legally restricted for a specific purpose would be there. And then the unrestricted portion is the amount that is under your control. And you can see that this is a deficit 11 million. It is an improvement from 2017 and an improvement from 2016, but it's still a deficit 11 million. On slide number 13, this is just taking your overall revenues minus your expenses on a full accrual basis and just showing you what the results were. Again, this full accrual basis is very different than looking at your general fund, which I'm going to look at in the next slide. This takes into consideration depreciation and many other things. All right. Okay, no, I'm sorry. I thought I missed the slide or something, but it's coming. So this actually is an important ratio for you to look at. So what this slide does is it calculates something called the net cost of service to tax revenues. So the net cost of service is the cost of running all city departments minus any revenues that those departments are able to bring in on their own. So, for example, fees that are charged to customers or grants that those departments are able to bring on their own. And the idea is to see how much is left to be covered by tax revenues. And obviously you want your tax revenues to be higher than your net cost of service. That shows that you have enough tax base to cover that deficit. It is totally normal to have deficit. That's in every city we see. No departments are self-sufficient. They do rely on tax revenues. So in your case here, you will see that as of 2018, your net cost of service was about 3.4 million. Your tax revenues were about almost 4.2 million. That's a healthy ratio to have. That means that your tax revenues are sufficient to cover your cost of service. If we move to slide number 15, that's just focusing on only the general fund. So you probably are aware, and we're going to talk about it more, that the general fund obviously is not in a very good financial condition. What we're seeing though, is that it is improving. And the city is, you can see from the expenditures that expenditures are lower than the prior years. So the city is taking steps to reduce expenditures. Also, the city have taken steps to remove liabilities and receivables that really had no chance of getting paid or collected, which I believe is the right step in the right direction to acknowledge what the situation is and deal with it as is. So this deficit is after removing a lot of these borrowings between funds that the city determined that they're not really going to be collected. So there's normally when we present this slide, we show our clients how much reserves you have in the general fund and how many months you can continue to pay your bills with your existing fund balance. It's obviously not very relevant here because it's negative, so the topic will not be relevant here. If we go to slide number 16, just looking at your pension liability. So your pension liability is calculated based on an actuarial study that CalPERS conduct. It's an estimate. There are a lot of assumptions that goes into that estimate, and one of the most significant assumptions is what we call the discount rate. So this slide shows you how sensitive your liability number is to changes in that discount rate. So currently your liability is that middle line, that 7.15% discount rate. So if CalPERS changes the discount rate to 8.15, your liability goes down to $5.5 million. If they change it to 6.15%, your liability goes up to $13.5 million. Fortunately, the 8.15 is an extremely unlikely scenario. The more likely scenario is a 6.15. We already know that CalPERS is now below 7, and they will continue to do that. So what that means to the city is you will be required to put more money in the plan in the future as CalPERS try to fund the plan and keep them at that funded status that they want. So that's a challenge that obviously all cities and all municipalities are facing. On slide number 17, that's the OPEB liability. The OPEB liability stands for Other Post-Employment Benefits, and we are really talking about the retiree medical benefits. So it's a much smaller liability. This liability is also an estimated number, and this slide and the next slide will show you the sensitivity to some of the estimates. So one of them is a discount rate, and the other one is the healthcare trend rate. And it just shows you how your liability will change if those assumptions change. Actuaries are the one that determine these assumptions. However, the city is supposed to review them and make sure that they are reasonable and that the city agrees with them and approve them. With CalPERS, you really don't have a lot of say. You're part of their plan, they are the actuaries, so you can tell them that you don't like the assumptions, but I don't really think that they will change anything. On the OPEB side, you hire the actuary, you can definitely have discussions with them about the assumptions. However, most actuaries tend to follow CalPERS assumptions, so that we don't find a lot of variations there.
So this would go up to council?
The
OPEB?
Will go up to council?
For approval.
Not the assumptions, I don't believe so. I think it's just something that management work on with the actuary. But I don't believe that, at least based on my experience with other cities, I don't see council.
I doubt if we have very much input at all, really, in when it comes to actuarial assumptions.
No, I completely understand.
Yeah.
Well, my experience is that management normally, which is rare, if they see that the actuarial assumptions are not reasonable and under the circumstances, they may have a discussion with the actuary. If the actuary is being aggressive in assuming rate of return on investments or anything of that nature. But most of the time, the actuaries are also governed by their own professional rules, so their assumptions have to be within certain parameters. So we don't run into those problems very often.
So let me interject here quickly. So with these retired medical, in order to qualify, you have to be with the city for 20 years, and then we help pay part of the medical between that age you retire and when Medicare kicks in. So this is assuming every city employee stays for 20 years and fits that. We only have 3 that are in the program right now that even qualify. So while these numbers are on there and showing the liability, in reality, it's likely not going to be that high because you just don't have that many that stay the full 20 years and then retire to a point where there's still space between where they're retiring and getting Medicare.
Is that similar for the pension retirement too? I mean, the assumption is X, but the reality is Y.
No.
Okay. On the next slide are the required communications. So on slide number 20, on the left side are some of our responsibilities as your independent auditors. On the right side are management responsibilities. So we're mainly responsible for providing an opinion on the city's financial statements, whether they're fairly stated or not. In order for us to do that, we have to evaluate internal control over financial reporting. We have to evaluate the tone at the top and making sure management do care about the audit. They address audit findings. They come up with corrective action plans. They send the right message to the rest of the organization about the importance of controls, the consequences of committing fraud. We're responsible for evaluating compliance with laws and regulations, ensuring your financial statements are clear and transparent, and then finally we are responsible for communicating with the City Council. Management have a lot of responsibilities in this process, so management is ultimately responsible for the completeness and accuracy of the financial statements. So even though you hired us to certify the numbers, we only provide reasonable assurance, we only look on a test basis, we have thresholds for materiality, so we're not in a position to provide absolute assurance. Reasonable assurance is a high level of assurance, but it does not relieve management or the City Council from their responsibilities towards basically the financial reporting process. Management is the one responsible for establishing and maintaining internal control, for establishing and maintaining controls to prevent and detect fraud, for informing us of all known and suspected fraud, taking corrective action on any audit findings, comply with laws and regulations, and I think that's about it. That's actually quite a bit. All right, on the next slide is our independence, and obviously we are called the independent auditors, so it is really solely our responsibility to ensure that we remain independent. We look at independence from many aspects. We evaluate all services that we provide the city, from preparing financial statements to any kind of consulting service, and we have to evaluate whether those services impair our independence as the auditors. We also evaluate relationships, so we circulate questionnaires to all of our staff, asking them to identify any direct or indirect relations with the city or city staff, and we make sure that those individuals are removed from the audit. We did not identify any, but if we did, we would have removed those individuals. We also try to be careful about the perception of independence. So even though I don't see anything wrong with going out with Brett and going out with the city manager and maybe having drinks, but we don't do that because we don't want to be seen as very close to management. So that's just our personal policy, I guess, not to do that, at least frequently. So obviously we determined that we are independent, and otherwise I would not be standing here presenting the audit. On the bottom of that slide, just wanted to give you a listing of the new accounting standards that the city considered during the fiscal year. GASB 75 is a new standard to account for the retiree medical benefits. So that's the only one that is new. We considered the other 3, but they were not applicable to the city. On slide number 22, in terms of management judgment and accounting estimates, so some of the numbers in your financial statements are not actual numbers, they are estimated. And that is okay as long as there is a reasonable basis behind those estimates. So just wanted to give you examples of some of these numbers that are estimated. Pollution remediation, pension plans, useful life of assets, all of those are estimates that are in the financial statements. Also wanted to highlight for you some of the important disclosures in the financials. Obviously the going concern, the non-compliance with grant rules and regulations, all of these are important disclosures in the notes that talk in great depth about the nature of the non-compliance, what the city's doing about it, also talking about the city's financial condition and what the city's doing about it. On slide number 23, Difficulties encountered in performing our audit. I'm saying see findings, but in terms of working with management, we really had no difficulties. I think one of the good things about this audit is that we really feel that management is trying to do the right thing. They're just trying to acknowledge the facts, the situation, and find out what is the best solution for it. And that makes our job easier because we feel that we're all on the same side. We're trying to make sure that we have clear and transparent financial statements regardless of what those numbers are saying. So yes, we did have findings and challenges, but we felt that the relationship working with management was a positive experience from our side. We had some adjustments to the numbers that management provided to us, and we proposed adjusting entries, and management has posted all those adjusting entries. We did identify significant risk or exposures. Obviously, what we mean by that is there are a lot of unknowns in the city's financial statements. There are liabilities to granting agencies, money that were used for purposes other than what the grant was for, and we were not in compliance with the grant agreement, so we don't really know what the end results of those would be. We understand that the city is working with those authorities or agencies to come up with a solution, but it poses uncertainties basically, and that's what our audit report is also saying. We have no disagreement with management, like I mentioned. We feel like we are all on the same page in terms of what the issues are. Of course, it is really up to management how they will be addressed. We just report on the issues. So in terms of the findings that we reported on our report, so we had 3 material weaknesses and 1 significant deficiency. Material weaknesses are the most severe. So this is the highest level of severity that we can offer, and then there's only really 2, either a material weakness or a significant deficiency. So it's either one of them. So of course the first one is the deficit fund balance and the going concern issue. So even though we saw positive signs, there's still a long way to go. The general fund is still $5-6 million deficit. There are some other funds that also have deficits. Obviously the enterprise funds, the McDermott and the Wellness Center, still running losses, and so there are definitely still a lot of financial concerns. But this year there were positive signs, and but still a long way to go. Also, like I mentioned, the non-compliance with laws and regulations, so the notes to the financial statements and our findings talk in great detail about those compliance. So they are really multiple layers, where there are some non-compliance with HUD, there are some non-compliance with Caltrans, there are some non-compliance with some outstanding loans. So that the notes and the findings are describing those in more detail. Yes, ma'am.
Excuse me. In your professional opinion, were we on the verge of committing fraud with all of these transactions?
Were you on the verge of committing fraud?
Was the city on the verge of committing fraud?
Well, I mean, so these things happened, as far as I know, a few years back. So they did not occur when we started the audit. Those were things that were probably from maybe 2010 or 2000. I can't recall that exact. But I guess it really depends on how you define that. For example,
in a legal sense.
Again, I'll be hesitant to say the word, but there are certain things like the utility funds. The Prop 218 says that this should be used only for utility service. So if the city tapped into those funds and now have no money to pay back, I mean, I'm not sure if legally that would be considered fraud, but it's, from our perspective, it's a non-compliance, it's a violation of law, and that's what we're reporting on. Same with HUD, where money was used for other purposes. And I think part of it also had to do with not understanding how the accounting worked, because the city pooled all its cash of all funds all together, so it becomes sometimes easy not to see that Well, if the general fund is continuing to pay bills but has no money, then you have to ask, well, where's the money coming from? And the answer was, well, the money is probably coming from HUD, coming from Caltrans, coming from other restricted sources. I wasn't there at the time, so I'm not sure if the person knowingly spent the money knowing that they're spending restricted money or not. All I know is that when we arrived on board, we saw that situation, we asked the question, where did the money come from? And I think we had a lengthy discussion with management, and we all agreed that the money had to come from some restricted resources, and that's the reason why you have those non-compliance findings on the financial statements. Prior audits did not necessarily disclose all of that. I mean, they did disclose some financial issues,
Well,
but not necessarily.
I don't know.
It was before your time.
Yeah.
Yes, sir.
It did.
Let me jump
basically-
in real quickly, please, just
Oh, yeah.
real quick. So on your question, they write a letter, and we have our management discussion and analysis.
Mhm.
And in that, and in the findings, there are sentences that state, with your Prop 218, here are potential consequences of that happening. And so he addresses the different challenges the city could face when dealing with those Prop 218 issues with utilities. And so that's identified in the budget or in the audit report.
Right.
Well, it's great that it's identified. However, it should not be happening.
Well,
I know on this question it should not be happening, but I guess it did happen from years back.
right, in the period.
All we can do right now is to report on it and try to figure out how to get out of that situation.
Yeah. The only thing
but I
that
agree, of
concerns
course.
me, the only thing that concerns me is that it continued. We thought we had stopped it, and apparently it's continued, and that is my concern.
Well, but the time period of the issues are basically from 2009 and 10 to about 2016. Is that?
Again, I came, my first year on this audit was 2017.
17, okay.
So I know that things occurred in the past. I did not go to the specific year to find out when exactly did it happen. But I agree. Yes, of course, these things should not have happened. They're not common things that we see in most cities. But you're not my only city who's dealing with that, and it's really I think that the important part about that pooled cash, it's really like if all of us are sharing the same bank account. Sometimes it may not be that visible that maybe I don't have money, so if I'm still paying bills, I'm probably taking money from somebody else. And those situations were happening, and it's a question of whether the people in charge of the finances understood that and intentionally did it or didn't really understand it. And unfortunately, sometimes I do run into situations where I feel like the individuals did not really understand that this is what's happening.
Well, my concern is that it happened a while back, and we just found out since it's the first audit that it came forward that it apparently has been happening since 2010, but my concern would be if it happened back then and it's still continuing, or up until last year, do we still have people working for the city who continue to do the same thing? That's my concern. If we had people in the past, whether they're in financial whatever, in whatever position they were in, or whatever it had to do with financial, moving money around, or whatever, however you want to call it, are those still people working for us? That's what I want to know.
So I am not aware that things are continuing to happen, but again, there are, for example, as of last year, there were receivables in the enterprise funds basically saying the general fund owe us money. So we had discussions with the city and said, well, how realistic is it that the general fund is going to pay this money back? And the conclusion was it wasn't very realistic, and so the recommendation is to, okay, let's write off this receivable, and that highlight the issue that now that you're not recognizing that receivable, that means that you're acknowledging that you took the money. Borrowing happened between funds all the time, as long as, and it's fine as long as the money's is being paid in a very timely manner and in expectation for revenue coming in. It is not fine when there are no expectation for revenue coming in to pay for it and it continues to happen. I am not aware that this is continuing to happen in terms of spending and taking money from other places. What I'm seeing right now is cleaning up, acknowledging that some of these borrowings are just not possible to pay back, and
And I get that part. I'm not an accountant, nor am I a CPA, nor am I, in any way do I have a certificate. However, just by the few minutes that you've been talking, restricted to me means do not touch, because that's for certain specific services. So I don't understand why it is so difficult to understand that for everybody who's in administration, who has a certificate, who has that knowledge, and did not do that. And how many people at that time knew that was going on and didn't do anything about that?
I mean, these are good questions. I wish I have answers for them, but I totally agree. Restricted means it should not be used. That there are no questions about that.
But we are well on the way of being able to correct those past indiscretions and being able to create a system that is far more transparent than we've had in the past.
The city is taking actions to address the issues. I would not say well on there's still a long way to go to pay all of those and make everybody whole.
Right.
But yes, what we're seeing is that the city is trying to find new revenue sources, obviously stop that type of accounting that was done, and reach out to those granting agencies that their money was spent and tell them, which we advise the city to do that, is to tell them, this is what happened, we want to make it right, what do we need to do?
Which I think we've been doing that for years.
No, we haven't.
No, I mean, reaching out to the agencies and begin a dialogue with exactly what the auditor said.
With the granting agencies, yes.
Well,
We have been
what,
reaching
recently,
out
as in like
for a long
last year?
time. No.
Probably. Yeah, because you're stating that last year, or just barely coming up. All this is barely coming up, barely just last year.
In
Or just right now.
2015, in 2015, we reached out to HCD. As we've understood, we knew there was a problem, but as Ahmed has mentioned, you have a pot of money, and in fact, when Councilmember Watson came on, that was one of the first things that he wanted to solve. Where is this coming from? And we went through several finance directors to get to where we are now, to gather an understanding, and even with Brett and then with the mentorship from Eric Frost, it's still taken time, and working with Mr. Madawi here, we've been transparent every step of the way with the goal of fixing this. We identify it. When we find it, we reach out to people and tell them what's going on and say, help us fix it. That's been the mission of your senior staff since 2015 when I've been here.
Well, the McDermott's still open, so that's one of the, I don't understand.
Bill, it's not, he brought it to light. It should have been this administration's responsibility to have been doing it right all this time.
Well, how could it be their responsibility when they only took over in 2015?
But
and
they
it's just been
kept
going
on transferring, they kept on transferring
But if it
funds.
hadn't have been for Bill, Brett, Eric, Laura, myself, Pam, Danny, and Steve getting to the bottom of this.
That's ridiculous.
No, it's not.
ridiculous.
It's actual. You know, it doesn't fit your narrative, therefore it's ridiculous to you. But the facts are there.
Wow.
Yeah, and this is the reason why all this is coming to light. Had it not, it would have been very easy for the commingling of funds, the big pot of money, to be continuing.
Well, I beg to differ, because that came out in 2010. When everybody went to the high school, it was all regarding this mismanagement of money. That was in 2010.
So why-
Everybody else knew besides who you just named. And they were the ones on the inside. So I don't believe one bit what you're saying.
Yeah, that's true.
No, it's not.
Yeah.
No, I'm not gonna sit here and argue with you. If the numbers already show that back in 2010.
Need to let the
Auditor.
Auditor,
conclude his.
sorry, I apologize.
No.
I get a little upset.
I completely understand. No problem. All right. So we were talking about the non-compliance with laws and regulations. The third issue we had was the restatement of the prior year financial statements. So anytime we discover that the prior year financial statements had some errors, we restate them, and we also ask the question how this was not detected by the city's controls. It usually is a reflection of a weakness in internal control. The control deficiency that we had was control over accounts receivable. So that was a little bit of an improvement from last year, where we were expecting that the city would be able to generate a report that tells us in detail who owes money to the city in terms of the accounts receivable. The city last year was not able to generate that report. So this year the city was able to generate the report, it's just it did not match exactly with the accounting records. This is not unusual, but it is still an issue, and obviously that's why we're bringing it up. So our recommendation is to have a reconciliation done between that sub-ledger, that detail of the accounts receivable, and what we call the general ledger. So those were all the comments that we had on slide number 24. Obviously, the financial statements is in a final draft form, so if you have any comments on it or you have any edits, we still have an opportunity to do that. We will be finalizing those financials in the next few days. Before we do that, we will obtain a representation letter from management on city letterhead. And in this representation letter, management is gonna basically tell us that they have disclosed to us all known facts, that they are not aware of any fraud that was not communicated to us, that they have recorded all transactions, that they have the rights to all assets, and a variety of other representations. We're not aware of any significant accounting or auditing matters for which management consulted with other accountants. Normally, when there are differences of opinions, management may seek consulting second opinion from another CPA firm. Normally that CPA firm should reach out to us to make sure that they have all the facts before they give a second opinion. Other than our engagement letter and the representation letter, we had no other written communications with management. There were, like I mentioned, some material uncertainties relating to events and conditions, the pending results of all these non-compliance issues. And we have not become aware of any instance of fraud or illegal acts other than the ones that were disclosed to us by management. I think other than that, this is a listing of all the new accounting standards that are coming in the future years. Every year we discuss with management the new standards and what it will take to comply with them. We also hold an annual training seminar. It's unfortunately in the Bay Area, but we invite management. It's a free all-day seminar for training on accounting standards and auditing matters and control issues. Other than that, I want to say thank you very much for having me, and I'm more than happy to answer any additional questions you have.
Thank you, Mr. Badawi. Thank you for being here. It's not something we've seen in the past, that our auditing firm, represents in person the audit. None of us, of course, are happy with the financial situation, but appreciate your efforts in making sure that the statements are accurate.
Thank you.
Would you go back to 23, please? Just give a little bit of context what we're looking at. So last year we had 7 findings. This year we have 4. Under material weaknesses, that's where you see them. So the deficit, fund balance, and ongoing concern, that will continue until the city gets to the point where it can have reserves again in the general fund. So that's been on there for years to come. The non-compliance with laws, regulations, contracts, and grants, that's dealing with HCD, Caltrans, the others. That will continue until our negotiations are finished and we come to some resolution on those. So those 2 are kind of locked in place. They're going to be in there every audit until we have those matters resolved. The restatement of previous issued financials, that dealt with the overfunding to SIP that then had to be refunded back to the utilities. And we had to restate the prior years. We did that. That was a resolution we brought to council a couple weeks ago. That's not one that's going to repeat next year, so expect that one to be gone. And then the controller of the accounts receivable, we need to upgrade our accounting software to be able to manage the reports that they're asking for. And so that one, if we're able to do the upgrade, it's about $17,000 this next year. Should rectify that issue as well. So this audit covered June or July of 17 through June of 18, and since then we've made additional improvements past this point. Is there anything I said there that's not?
Definitely headed in the right
Just to
direction.
give you some context to where we are.
Okay. Thank you
And a
very
little
much.
bit of reassurance, restricted stays restricted, right? We're not taking nothing out of there. Is that a different account or is that also in the general fund?
So a restricted account is going to have its own classifications in the system. It's not a separate bank account, if that's what you're asking. In some instances it is, in some it's not.
Okay.
And so what your general fund ledger identifies how much cash in the bank belongs to which fund and which of those are restricted, which are not.
And is
situations.
the road tax for the roads, is that a restricted fund?
It is a committed fund, which is similar to restricted, means it's committed to that particular use.
One last question. Do you recommend that we have more restricted funds to where the commingling
Well,
doesn't exist anymore?
so almost every city we work with have restricted funds. That's just the nature of your operation. Most cities are able to manage. The idea of having a separate bank account for each restricted fund and each grant is a nightmare, because you have to reconcile every account, and it's just an administrative nightmare. So most cities, that's the whole idea of pooling, is that they have 1 or 2 or 3 main bank accounts where all the money is put there, and then how they allocate to the different funds and keep track of what is restricted, what is not restricted is on the accounting records. So how they code every revenue, that say this is going to the housing fund, or when they pay an expense, they say this is coming from the general fund. The issue happens is when you are ready to pay a general fund expense and the general fund account on the city's books shows 0 cash, but you still go ahead and pay the expense. Then it goes into negative. The idea is, well, if you are not expecting any money to come in to reverse that negative, that means that you took money from another fund. So you look to see, well, what other funds are out there that you took money from, and the only ones that had money were the restricted ones. So this is how we drew that conclusion. I've seen cities where the county, after our audit, and a similar situation like this, came in and said, we no longer trust that you can actually maintain our cash and not spend it on your general fund. So we want you to create a separate bank account and put our money in a separate bank account. So these are sometimes imposed restrictions that a granting agency or a regulatory agency may impose on the city. Or honestly, if the city feel like we can do it, and you may want to open separate accounts and keep the money there, but I feel that this would be a very big undertaking to try to reconcile all those bank accounts.
Thank you.
Thank you, Ms. Friedel.
Thank you.
All right, thank you very much.
We'll move on then to item 10, which is about concerning authorizing staff to release an RFP for cannabis retailer. And,
On item 9, I believe we need to do a motion to
oh,
accept.
we need a motion to accept it this one?
It's in
Okay.
draft form, but to accept the finalized, so it's.
Okay, so this a minute order? Okay. Is there a motion to accept the auditor's report?
So moved.
Is there a second?
Second.
Moved by Watson, seconded by Sanchez. All in favor?
Aye.
Aye. Any opposed? Motion carries. Thank you. Item 10, Bill?
Thank you, Madam Mayor. You recall the slide, please? So we've had several meetings talking about cannabis in general and then retail cannabis specifically. The direction that council has given is to locate retail cannabis within the Central Commercial Zoning District. You have a partial city map in front of you in color. The Central Commercial Zoning District is that area that's in dark red that you see there. The Central Commercial Zoning District extends throughout most of the downtown area. bordered on the south, kind of where you see the green line on the screen, but going north to the north side of Hermosa. It also exists out at the Olivewood Plaza, and it exists around the old Inglesby Flower site, some of the places along there. Council's determined that they would like to have it located downtown. So we can do this by suggesting or directing that it be located in the CC district. The proximity of the Olivewood Plaza, the shopping center, to the school prohibits its consideration. You have to be more than 600 feet away from a school, so we don't have to concern ourselves with it locating out there. You have around the Inglesby site, you are very close proximity to housing areas, and council has expressed to me that they're not keen on that idea. So rather than go through the time, and council has stressed that time is of the essence on doing this, of creating the overlay zone, which was what this originally was, staff has proposed to council, and you've just supported to this point, that we would incentivize locating downtown within this green polygon. And we have the map up there. We would also incentivize locating within blighted buildings. And so when people compete, you assign a certain number of points for going in particular areas. And council has identified that they would like to take a look at blighted buildings. And so those red rectangles that you see within the green polygon would be the blighted buildings that we are aware of. And so you have, I think it's called the old Grayson Landers Hardware Building. You have the Moore Building. You have the Sullivan Building. Is it the Bank of America Building that's on the southwest corner of Elmwood in Honolulu? You have that building. And then you have the old pharmacy building there. So those are the blighted buildings that we are aware of. There certainly are several empty buildings there. So we would propose incentivizing that. We would award points, additional points if they have an existing successful business. Whoever comes to town, you'd like to see thrive and be successful. And we recognize that sometimes folks think that they can do this and they're not ready to navigate the state bureaucracy, or they're underfunded to do the sorts of improvements that I think council would like to see. We would award points for having a positive relationship with the governmental entity in which they are located, and we would request a letter of support from that local entity. We would ask the applicant to describe what other improvements they would propose to either do or contribute toward downtown, in addition to opening the retail establishment. Award points based on the extent of improvements, and then award points for those who would conduct local deliveries, that is within the 93247 zip code, from their establishment within the city. That's something that several of you wanted to ensure that we were able to capture those revenues also. And as I've heard council say, you would propose up to or no more than 2 retail establishments. Does that sound like your direction that you've given to me?
Yes.
With that, staff requests permission to go out with an RFP identifying those items.
So do you need a motion? I motion to move forward with that ordinance. Do I have to read this?
Just to issue the RFP.
No,
Oh.
this is just a minute order.
Okay.
Slow down.
I think you did right.
So, well, we have it needs to be a little clearer than that because move forward with this. So this
I
is
move forward with the RFP proposal
As described.
as described by Bill.
Second. Okay, it's been moved by Flores, seconded by Cortez. All in favor, moving forward with an RFP, signify by saying aye.
Aye.
Any opposed? Motion carries.
Thank you, council.
Okay, we're on our way.
Next item will be a study session on the housing element.
Madam Mayor, staff respectfully request that we table this for one meeting. We need to have an engaged dialogue. I think a lot of emotion has been spent in tonight's conversation, and we're looking for ideas. And with your indulgence, I would like to move this one more meeting.
We have time constraints on. Yes.
We do have some time constraints, but this is based on what we've already done with the housing element to see how you feel about steps that have already been taken and if you have new direction for staff to take. And you know what I can do is I can share the elements of discussion with you so that you can preview it prior to us meeting next time.
That might be
Good
good.
idea.
We
It's
can
always good.
see the past housing elements that, okay.
It's a complex document, but I do have the talking points there that are pretty concise.
Okay, everyone okay with tabling till the next meeting?
Thank you, council.
Then our next item is a review of McDermott X financials, Brett?
All right, you can get that up there. All right. So we had, during our last council meeting, there was a request at the end to include an agenda item dealing with what can we do with McDermott and the contract. So that's what we're going to look at today. I left a packet of paper for you. There's a lot tonight, but you have a copy of the presentation there, so if it's easier to look at off there instead of the screen, we have a copy for you. So we're going to go through this. Would you advance to the next slide, please? So starting with the timeline. We've shortened the timeline up here for the purpose of this discussion, starting back to late 2017. This assumed council authorized a transparent RFP process to look for someone to operate McDermott. We've had the finance department been looking pretty heavily at it and found that the city just could not continue to operate it and not run into financial troubles of overruns and the like. And so we went out to RFP that year and had our respondents. I've also included all of the information involved in that entire process in the packet left for you in the days as well.
Real quick, did you say a packet for us? Because I didn't get one.
The big paper clip? Or
This
is
one?
it? Yeah.
Oh, it's with this?
It is, yeah.
Yeah, it's in the back of
Okay, I got it.
That's
No, where is it? Oh, is this
All right,
it?
yeah, it's way down there, because you've got all the audit stuff first. And so the very back, if you, so there you go. All right. And so you have two items there. One is the presentation, and the second one with the eco-stapling on it is the contract. Okay. All right, so 2017, went out for the RFP and had one respondent through that process. It was called McDermott Ventures, Inc. And so they were the winning bidder in that process. I've shared with you in that packet as well all the different individuals that we communicated with, reached out to, the brokers we talked to, just trying to find someone that would be interested in coming into the location. And despite all those efforts, we had just the one. And so they took over full operations on January 1st, 2018, and the city became landlords. And so that means that we're responsible for the structural building, but the contents, the activities, the rest are up to the operators. And so mid-2018, Karen Patterson of HCD, that's the California Department of Housing and Community Development, came for a visit with the city. We've learned recently that she's retired, which in my opinion is quite unfortunate because she understood the situation that was going on in Lindsay. But she came down and she warned the city that we may not be able to sell the building due to CDBG funds being involved in the facility. So after a trip to the basement, to ComDev, through my involvement in my office to track down everything I could find on the different loans or grants associated with CDBG, I have found just 2 binders that reference that. And both have phrases that I'll read to you, and it says, if the City of Lindsay chooses to sell the property and or the business, the McDermott Fieldhouse and Sports Center, within 5 years, future lease agreements for companies to access the infrastructure should be converted to a loan to the purchaser. I'm going to pause to kind of translate that. So they're saying, hey, you sell this, whoever buys it needs to accept a loan for the funds that came from CDBG, and they need to repay the city through program income. Okay, that's what the rest of this says. So at a reasonable term and interest rate to conform to the CDBG underwriting criteria, which states to the extent practicable, the ROI is not unreasonable. Principal and interest resulting from such a loan would become program income. I took that as good news because we're looking back to 2010 or so, and that's when that clock would have started. 5 years later, 2015. A 5-year moratorium on selling makes sense because the only things that we use the CDBG funds for were $2.5 million worth of equipment. Equipment is depreciated over 5 years. And so they're basically saying, hey, once it's depreciated, we don't care anymore. Now, staff's not going to take just our investigation for it. We've sent request to the HCD attorneys to confirm that there's nothing that's going to prohibit us from selling the facility if we decide that we want to. Okay? We're still waiting for response to them, but the research we've done so far identifies that there should not be an issue with that process. And so in December 2018 then, we got the first revenue sharing payment from MVI, or McDermott Ventures Inc. I've talked with them, and what I've learned today is that they had made an estimate as to how much they expected to receive by the end of the year and paid on that estimate. We got $15,000. As it turns out, there was an outstanding, not outstanding, but a lately billed item from SoCal Edison for them that came in January, that was for December, that actually took another $7,000 out of their share of what would have been their 15. So they ended up with 8, we ended up with 15, even though it's supposed to be 50-50 split. And so we ended up faring better in that situation than MBI did. So that is the circumstance with that. Let's go to the next slide.
Can I interrupt really quick? The $30,000 that was given to them for repairs, where was that? I didn't see it on any of the warrant lists.
I've got the invoices and the references and the materials I left there for you. There are 2 memos that talk about that money. A lot of it is for school district payments that were for activities under MBI's operations, but came to the city instead of to them. And so they had talked with us and said, hey, there's money coming your way. Can we use that for the repairs to the facility? And so the money went back to them to do the structural repairs for it. And so it's outlined in all those memos there for you.
That type of stuff just can't keep on going on, because you stated that you had given them $30,000. I looked through all the warrant lists from a year past. There's nothing there. There's no paper trail.
Then I can go back and find the check numbers for you, so we can identify which ones those are.
Yeah, but it should be public record. It should be on the warrant list.
If there was a check written, it's on the warrant list. I just need to find the number and identify which one it is for you, because there are some payments that go that direction for them. So as McDermott took over there in January 1 of 2018, you have momentum with invoices, with payments, all of that. And so it takes a couple months for those billing cycles to come through, both for the vendors that are sending accounts payable to us to pay and the others. And so there is several months after that end where the transactions being handled by the city or by McDermott until we both get things worked out. Because you can't just stop on day one and say, okay, no more, because none of the vendors know to stop sending the forms to here or there for the invoices. And so we can sit down, like come by the office and go through all of that for you to make sure that you understand where things stand.
Well, it should, there should be a paper trail, and it should be public.
There's a paper trail there with it, and that paper trail is public. And so,
well, because I didn't see it, and I reviewed all the warrant lists for the whole year.
Well, we can look at it together and see if we can figure it out. Then. So with the next one is talking about the benefits of what McDermott does for the community and other things here. So under community health, you've got reduction in gang participation, reduction in crime, improved academic performance, improved performance in school sports, safe environment for children, youth, families, and individuals. It's made a huge impact on the youth of the community and the school district by having McDermott there. We have the revenue sharing, 50% of net revenue at the end of each year. This last year was $15,000, and then the cost savings. So we have a minimum of about $400,000 annually that they're saving by operating on our behalf. So it's not just from us not having the expenses there at the facility that they're taking on. They pay the solar costs for the building. They pay all of the electrical, all the gas, everything else here. And I've got some slides later to show you everything of how those are split. But there's an indirect reduction in the demand on public safety. There's an indirect reduction on demand on city recreation programs that we would need to offer if they were not there offering recreation. There's a reduced direct demand on city if we're operating McDermott. And then, as we mentioned earlier, named Eric Frost, when we went through it together, there's a cost of $400,000 to $700,000 a year
that it saves the city by not being the ones operating that facility. And so that net benefit there of at least $415 this year is a mix between the cost savings and the actual revenue sharing. And that does not include the economic benefit to the other businesses that surround them. So let's go to the next one. So the next set of information, data points we have here are from Daisy over there at McDermott. So in 2018, they had 195 groups come through, which is 18,060 children come through the facility. It's a big part of what they do over there is the school buses. You'll see them kind of start in late April, kind of through June. It's a big deal. And then the GUM program, that's a get up and move. So they had 1,031 in 2018 come through as 7th and 8th graders from Roosevelt, Washington, Reagan, Jefferson, Lincoln, and Kennedy schools. They've just reached an agreement to expand it to 3rd, 4th, 5th, and 6th graders. So while their number of 1,031 is an accurate number, I estimate that to be 31,000 in 2019 because adding 4 more grades, you just multiply the first one by 3 to get up to where you would be. And so that's where the 3,100 comes through from GUM program, which is pretty cool to see that going through with the kids there. Let's go on the next one. So the questions about the contract. Again, you've got a copy of that. So the parties to the contract are McDermott Ventures, Inc. and the City of Lindsay. They're the only 2 parties to the contract. MVI all has responsibility of all McDermott-related direct and indirect expenses, including but not limited to facility management, staffing, non-structural maintenance, utilities, upkeep, advertising, marketing, reinvestment, and taxes, except for the property taxes. So the sales tax that comes from activities there, they pay that. The City of Lindsay, as landlord, includes the structural maintenance, appraisals, which will split with them when the time comes, and the property taxes, if they ever become a part of that. So the next part is a term. It's a 5-year term with 2 optional 5-year renewal terms. The lease payment is 50% of the net revenues annually, and the option to purchase with HE's approval is once that 50% of net revenues payment reaches $100,000 in a single year, they're then eligible to negotiate for the purchase of McDermott. If it drops below that, or at a certain point below, even there's a 5 or 10% variance there. If it drops below that, the city can waive the process and basically start over and keep anything they put towards the purchase and not refund it. And so it's written there to protect the city's interest. So let's go on to the next one. So here's a list of different things that they pay versus the City of Lindsay. We're the COL on the left side and their MVI down the middle. I'm going to spare you on reading all of those, but there's this page on the next one. And so those 3 items I mentioned earlier, the structural maintenance, we had holes in the roof this last year that we were really concerned were going to be quite expensive to fix. We had estimates, I think, up to about $60,000 to get it fixed. We had some Mike's guys go up there, do some of their fancy work and fix the problem. And so we were able to escape having to pay that large structural maintenance cost. And so Mike's team does a good job of trying to handle those things when they come up.
So I thought that's what the 30,000 was for.
There is some for that, but there was a larger issue on there that they were able to fix that saved from bigger expense. Let's go to the next one. So here's the debt schedule. We still have about $1 million that we owe on McDermott, and that's we have to pay regardless of whether the building's operated or not. It's just a fixed cost for the city. You see this goes through 2026, December. We have a reserve account of $184,000 that is going to make that final payment for us. When you set up these different grants, you have to set a certain amount aside in reserve that's for any time that we may not make the payment. But it sits in reserve until that final one. And so the city general fund is just going to be responsible up through that 6/15/2016, and then the reserve account we have will be the one to pay that. If you look at the financial statements and see cash in McDermott, you're going to see it's $184,000, $186,000. That is that reserve account that's just sitting there dormant, waiting for that final payment. So then we have
What does it mean to the city? This, I believe, is the last slide. So we have three different timeframes here: before MBI took over, with MBI there, and then without MBI if they were to stop operating. We have the good benefits, the city, and then the negative externalities on the, or the bad on the right. Really what this comes down to is can you can't see that there, do you? Okay. So the good, before MBI, you had positive benefit to the youth and the community, recreation services, improved health and wellness, and economic driver. Big increases there in McDonald's, at the Fast Trip, the other businesses around there. Jobs, or a lot of jobs through the facility there, and it prevented blight in the area. The bad is it was enormous cost overruns, unsustainable vision, living beyond our means, damaged the city's finances, negative response from some in the public, negative response from the press, obstacles to other city services, and debt service. There was a lot that was not good before the city finally extricated itself from Unison and passed the operations to someone else. Now with that, the good becomes it's a positive benefit to the youth and the community, provides recreation services, it's improved health and wellness, it's an economic driver, continues to provide jobs, prevents blight, saves the city budget, and allows for financial recovery. The bad, though, is that we still need HCD's permission to sell it. We continue to have debt service until that's paid off, and we have landlord responsibilities. So if MBI were not there operating, we would have the good could be potentially divested of the facility if we were able to sell it. The bad becomes continued debt service, blight in the community, negative impact on the youth, increase in gang activity and crime, a loss of economic driver, assumptions of cost like the solar, PPA, utilities, etc. for the facility, loss of lease payments, an increase in cost for recreation, and continued landlord responsibilities until we're able to sell the building. So that's the condition there. That's where the 50,000 came from. It sounds like I need to track down some information on individual checks that I can bring back to you and identify those and put together a whole flow chart of what happened after that transaction.
All right. Thank you, Bill. This is an informational item, and we appreciate all of your, Brett. Sorry, it's been a long night. Yes, thank you, Brett, for all your efforts on this. All of these, just a minute, these issues and benefits were considered when McDermott was outsourced a year and a half ago, and so some of us are very familiar with those items, but we appreciate your work on this presentation tonight. I would hope if there's too many more questions, considering the lateness of the time, we've received a lot of information that you might be able to meet with staff to review anything that we didn't cover tonight.
Well, it should be here in the public, so if we need to address something, it should be here, not in private.
It's not an action item, is what I'm saying.
But we have questions.
You can ask your question.
So it says needs HCD's permission to sell. So if there's a potential buyer, it can potentially be sold, right?
With HCD's permission, we have some, I think I've shared with you the different granting funds that we found in the binders. You know, we've got rooms full of these binders. And we have to go through those to make sure that there are no prohibitions, but we knew there was a prohibition with HCD. So our hope is that's the only approval we need.
Okay.
And do you have an estimated time of when we're going to find out?
I sent this off to their attorneys a little while back. They're likely waiting for us to sit down and start having our dialogue with them, would be my suspicion, because, well, they're attorneys.
And when do you propose that's going to happen?
We wanted to get through the audit, and we talked about this at council. We wanted to get through the audit. We want to get a budget in front of you so that we have solid numbers that we can take to HCD to show where we are financially. So we say, help us work through this process.
Okay, and shouldn't we be asking the McDermott X or how,
For their
because I have
financials?
trust issues, of course. How do we just take their word for it that, okay, you made 15,000 and or 30 and we're getting 15? How do we know that that's how much they make?
That's a great question. It's in their best interest to pay us $100,000 because they'd like to own it.
Right, but they can
So
say
break it
that
out.
in year 5 or to do that? How do I know that they didn't meet that this year and they're just putting it off till the 5th year, right? Because that would.
I'm pretty sure, I don't remember off the top of my head, but that was a question that I had when we were going over the contract, and I'm fairly positive, I mean, I will check, but I'm pretty sure that what we did, because we had the same concerns, was we have the ability you have to open up your book so that we can verify that it is what you say it is.
Yeah,
So is that what we're doing?
yeah, that's what I
I
would
mean, I know
like.
you said it's an option, but are we doing that?
Because I thought when we were gonna have this meeting about McDermott, I thought it was gonna be an open book. I thought we were gonna see their numbers.
To see their financials.
Yeah, I wanna see their financials. How much are they paying themselves? Are they,
That's
Well,
not,
I don't think
that's
that's,
a private entity, you
Yeah.
can't bring their financials.
but they're paying us. They're supposed to be how are we gonna know if they are paying us what's due us?
50%.
We are their landlords. I think we deserve to know.
Well, I think that the part of the contract requires that we verify, and I mean, that's
You see?
one of the things, like, we're gonna have to do that. Like,
Thank you.
I mean, quite frankly, if they don't like it, it's too bad, because that was the contract.
Thank you.
They've been willing to show.
Yeah,
It's just not an open meeting discussion. They would come.
right, that's for us, we need to actually
Okay.
verify.
Mhm.
But it wouldn't be something that we would bring to a public meeting like this. It's something that we would do. Well, no, but I mean,
As long as
I
we
get
know.
that, but as long as, I just wanna know, how do you determine?
Enough to verify the numbers.
Exactly,
Yes.
are you saying, you know what, I wanna see documents, not saying, you know what, Phil, today we made 30, so we're gonna give you 15,
I understand your concern.
so I don't,
So we structured the agreement to incentivize the sharing of information, and they are penalized the longer they wait until they hit that $100,000 mark. Because what happens is if they build the business up to the point where they're hitting that 100,000, they've made improvements to the facility and everything else, the appraisal's gonna be based upon the value at that time. They want that appraisal to happen as soon as possible. And so the faster they get to 100, the better it is in their interest. So they're gonna pay us.
Or they could be paying themselves $10,000 a month. Who knows? We don't know.
yeah, but it's a private business, so, I mean,
We're the landlords.
I
Like
think,
you said.
I think Samora, their attorney, said that you guys do have a right to look at those books. So I
Well, we have.
understand it's
Yeah.
not, so I think
But this
that you
is a
guys
discussion
can.
with council votes.
yeah.
Yeah, I
This
know,
isn't a
but I'm
discussion
just
with audience.
Yeah. Brett, a question regarding the economic driver. There's the economic multiplier, usually 2 to 3 times what a business might to generate in revenue.
I'd be surprised if it works that way with this. Primarily because most of their attendance comes from those school trips.
Right.
And so it's all inside the facility on that side of it, and the bus drivers are just waiting outside. So it's
Right.
not families coming for it. The rest of the year, we do have the birthday parties and the rest, that is gonna have a multiplier effect.
Right.
But it wouldn't be fair to say based on the entire attendance, because they're different types of groups coming in.
Right. So if we said we'll take 50% of their revenue, we'll just say revenue's 2 million, 1 million of it would have the economic multiplier effect to generate maybe a total economic value of $3 million or so to the city.
I wouldn't feel comfortable making that assumption, because there's too many.
Too many
there's
variables.
that I can't pinpoint.
But it does have an economic benefit.
There is some.
Oh, yeah.
For sure.
People are buying gas, they're eating fast food, certainly.
Right. Very good.
All right. Okay, thank you.
Very good.
We're about ready to be done. We can do requests for future agenda items or save that till our workshop coming up soon and entertain a motion to adjourn.
so moved to adjourn.
Second.
Okay, it's been moved and seconded to adjourn. All in favor?
Aye.
Nobody wants to go home.
Thank you.